Hi, this is Shane with the Rational Trader, and it is, what is it? It's Thursday the 5th of April. And, okay, so we're continuing the discussion that we started yesterday. The live trading will be after this piece here. And what we were talking about yesterday is carefully introducing change, and I was describing models I'd built with data through the end of last week using 3 different additions to the current known good model. And I was looking for an obvious winner, an obvious choice, and 3 days is not really enough. So I was kind of not surprised by the fact that I didn't get a clear answer. So what I did last night and today is I took data through February 2nd, which is kind of just before the wheels fell off the market and the road got real bumpy. And I built models, using data. So that would have been 26 months worth of data, 2 years and 2 months worth of data, using these 3 different cases. So we take our known good model and we add one piece, and we add another piece, and then we add a third piece. And then I built models on that data in 3 different cases, and then I ran a replay. Okay, and the replay ran from what you see on screen here. It started on the 5th, February 5th. The data was through the 2nd, and then it went through. The H contract ended on March 8th, so we went through the 8th. Okay, and so what we have here, let me move these replays off the screen. What we have here is this one in the middle, on the bottom here. All right, so starting clockwise from bottom here, so we're looking at this one down here. This chart had one piece of information added, all right. Then this one up here had a second piece, and then this one over here had a third. All right, now let me describe what we were adding, and then it'll make sense to you. So if you look at any bar, okay. Let's take this bar right here as an example. If you look at any bar, actually let's go into the middle of this wave right there. So this bar is the one we're looking at. If you look at this bar, it exists in relation to the bars that came before it. Okay, and so the actual machine learning models are using a large chunk of data already. Something like this. So the system is already looking. It's given sort of this amount of data as a time series, and it uses that to make its prediction. But you'll notice that there's some information missing here, okay, that is kind of important. And that information is these peaks and valleys here. Now, a few of them, the system could intuit, or it could figure out, but others not so much. All right. And so if you look at that, if you think about what a sideways market looks like compared to a market that's trending or moving, and you give to the machine learning system information about, for the current bar, how far away am I from each of these last points? How far I'm away from that one? How far I'm away from that? Not in time, but in distance. So I actually drew those arrows in a confusing way. If we're looking at this bar, the question is, well, how far am I in distance from this line right here? And then how far am I from that one? Okay. All right, so in other words, between the last peak in each direction, where am I? Okay, that would be one set of waves. Okay, one set of wave peaks and valleys. All right, and so this model down here, this one, is running with information from just the information that's been added is just the most recent peak and valley. Okay. This one, the second one, going clockwise from the bottom here. This one has the last 2 waves. So for this, again, for this bar here, we can go back to another set of waves. So there's here and here. All right, now we're talking about distance, so keep in mind. So the distance for that second wave is a little bit down. It's very similar to the previous one, but the distance to this one over here is pretty big. Okay, and so there's information there that you would expect the machine learning system to be able to make use of. So this one's going back 2 waves. So 2 sets of peaks and valleys. All right, the one over here, the third one, this is going back three waves. So if we were going to continue to use our example, we would include the next level, which would be here and here. All right. Now, it's very human to sort of think that the more information you give it, the better it's going to get. And certainly that's what I expect, all right, here in this case. But let's look at the results now. All right. So this one here is looking at just 1 wave back. Okay, so we just added the peaks and valleys. So we have all the other information we've been using, plus now one set of peaks and valleys. And the thing to keep in mind is that the model was trained on data through February 2nd, so just before the market got really volatile. Right? So I would expect actually all of these to perform really poorly because the character of the market changed so dramatically. All right, but it's the test that we can do, so this is what we're going to do. The next test would be train the models through sort of the end of March. I'm sorry, the end of February. Get a month's worth of crazy action into the system, and then test on the month of March. That would be a reasonable thing to do, a reasonable next step. So if we look at the trade activity log for going back, giving the model 1 wave peak high and 1 wave peak low, the results that we get are from, let's see, 2.4 through 3.8. You can see it's actually fairly miserable. Okay, so the P&L here for the day is in this column here. That's the whole row in this column here. And then the running P&L since you started is right next to it. So you can see a lot of days where you're taking max loss, all right? And one nice day right there. But in general, you're not doing too well, all right? There's a long stretch, 1, 4, 5, 6, 7, 8 days of not doing very well, all right? A little bit, certainly not enough to warrant running. There's a nice day, there's a nice day. But for the most part, you're not making any money, minus $60 at the end, not counting costs, all right? So this year's not good, all right, because the model that we've been running shows a much nicer profitability than that. All right, now let's jump to the other side. This is showing just 1 wave back. Let's look at this one. This is actually, can I make that bigger? Yeah. Let's look at this one. This is showing 3 waves back. So I would expect this to be a better model. Just intuitively, it seems like it would be better to me. And what you can see right off the bat here, that it has, it starts off okay, but it has a similar really long stretch. So there's either something about the market here that was pretty ugly, and the model just couldn't figure it out, and every day you get whacked. And then it starts to do okay. You make a little bit more small losses, make a little bit more small losses. Then you start to do okay. Small loss, nice big gain, small loss, or a big gain, small losses. And you end up plus 1,000, okay? So not actually bad when you consider the kind of the craziness of the market. And the market was basically untradeable for me as a human discretionary trader. I was just kind of sat here in awe watching it, and took little to no trades during this period. And now let's look at the one in the middle. And I did it this way in order on purpose because I found the results somewhat surprising. So this was the one we just looked at, shows information, to the system for each bar for the last 3 sets of peaks and valleys of the waves. And what we're trying to do here is help the system understand: is the market moving sideways? Is it choppy? Kind of just stay out when the market's going sideways. Is kind of what we're dealing with here. Much of the motivation was in the current volatility. you'll see it make a really sharp move and then go sideways. But the speed with which it made that move is so much that kind of normal methods of using the slope of a moving average aren't catching up in time. And so you end up, you might catch that nice sharp move, but then you get caught in that chop and it's really ugly. This chart here is running with a model that gave, it went back 2 waves. So for for this bar here, we're giving it information 1 and then information 2. And that's it. All right, we didn't give it any more than that. And I found these results fairly surprising because I was expecting it to get progressively better as we gave it more information. And I don't see that. This one here, starting at the beginning, you can see it actually handles that beginning stretch much better than the other two. Small loss, but it's punctuated by these big gains, all right? 650, 1200, 780. Small losses, nice gain. Scratch, basically scratch. Couple small losses. Here's an ugly stretch if you're tracking it daily yourself. Oh my gosh, I'm in trouble, right? But then a nice gain, small loss, a nice gain, small loss. This is actually kind of what you want to see as a trader, is small losses and big gains. Small losses and big gains. Now, as a human, that's not what you want to see. As a human, you want every day to be a positive number. And in fact, if I could make it like a small positive number every day, that would be really, really useful. But the markets don't work that way. The unpredictability makes it pretty spiky. And this particular period is really bad because the amplitude of the moves is so much greater. The running P&L here makes massively more than the other two experiments. So, giving the system just one wave back was, not good at all. Giving it 3, which I expected to be really good, actually it did better, but that's much worse actually than if you give it enough information about just the last 2 waves. So this looks like there's a sweet spot there in terms of understanding. Okay, well, how much information do I want to give it? This should not be surprising necessarily to people who have been trading for some time. We sort of understand that too much information is a bad thing. It ends up for us humans, we end up paralyzed by too much information. Paralysis by analysis is what we call that. From a day trader perspective, it also kind of makes sense in that I kind of only care about the next move, and so 2 seems to be enough. So the obvious next step here is to take this model and now run it through a more comprehensive set of tests. And so that would entail kind of what I did before I went live with the current model I'm using. And that means create a model for through September of last year, and then test it on the end of the year. Basically we needed to run a test during sort of normal times. Create a model that includes say all of February, and then run that on March. See how it behaves. What we want to do is be careful that we don't optimize for the current environment, and that which really damages us later on. Okay. To me, volatility like this, it's been so bad. You're better off just standing aside. And so I went live during this time, unfortunately, with the system, but it's provided some really good research data, and it's provided an excellent stress test. So I can't complain in that respect. But what I don't want to do is, in trying to adjust to the current environment, end up damaging the long-term use of the system, which is really much more important when you get right down to it. So I kind of like the progress here, and then we'll see what happens next. I'm going to sit down and kind of work through what the next step here is to take what I think now is the proper next step for the model, and then lay out the test plan for that. What we talked about on Saturday's tutorial, the last one, was that the information that I've given to the model is, in addition to the normal stuff, the first change I had made to deal with what I saw was, trades during choppy sideways action, was I gave it this information about the relationship between these waves, and the problem was that relationship looks the same even if you like tilt that and the market's angling up. All right, at least I think that's why I got a small improvement but not a dramatic one. All right, so if that's not clear, just go back and watch that video. In the first 10 minutes we described that graphically in a way that it'll make perfect sense. So what I've done now is I have the data, and I've started incrementally adding that data to different models to see the impact. That's what all these different tests are here. So this is what I'm running right now. Rev 49 is what you guys have out in the wild. So 50, 51, 52, 53, 54, 55. These are all basically incremental adds to the Rev 49. All right, and what we're doing here first is not just telling the machine learning system the relative values of these waves, but actually giving it the information that says, let's take this bar here, the closing price of this bar, where are you? How far away are you from the last point and from the last point? Okay. What's the distance in ticks from there and there? Okay. And from the previous one, and then one more back. All right. So I have the data now that says, okay, for the bar that you're looking at, Mr. Machine Learning System, here is where this is your distance in. This is how far away you are from these previous peaks and valleys in the market. Okay. And what I mentioned earlier was that at the beginning of the week, I kind of just thrown all this into the hopper and built a model and called it good and started using that here in testing, and that's really not smart. It's not the right way to do it. There's also other information that I've collected that I also threw into that hopper, and it's not a good way to go about doing this. So all these revisions that you see here are me taking the known good model that we're using and adding one pair of points. All right, so the first one is, okay, add the previous low and the previous high wave. How far away am I from that? And the next one is taking that model and adding this next one back. Okay, where's that? And then you just keep going. All right, and then running some tests. Now my problem is I didn't have enough time to run, a full set of tests. So I'm here's the market open, and so basically I didn't have time to get the data correctly for a time period that I could then test adequately. So really what you want to do is you want to test something for at least a month. That would be a minimum. And in this case, it would make sense to get models with data that are built through like February 2nd, because that's the day the wheels fell off the bus, and then you could test all through February and March. I didn't have time to do that yesterday, but I'll do that today. So what I did yesterday, though, was I did build sort of 3 candidate models that have these various amounts of information related to the, where are you? Where is price relative to the previous peaks and valleys? Okay. And where is that result? Let me find that real quick. All right, so here's that result, and the problem is it's somewhat inconclusive. The one on the upper right is just one set of wave peaks. So the wave high and wave low for the most previous wave. This one here on the upper left is adding one more set. So there's two waves, and then the third one down here is there's three. So you have a deeper view or a longer view back in time. And what you see here is that the first one here in the upper right pretty much mirrors what Rev 49 does. Monday and Wednesday basically get whacked pretty quickly, and then Tuesday was killer. This next one was really surprising because it struggled on Tuesday with a really odd loss here. That loss is too high, but it was actually the only instance of probably 10 or 15 different tests where the system actually turned a profit on Monday. And then this third one down here is more. You can see this is three sets of waves, three sets of peaks and valleys that are given to the model, and you can see a sort of what looks like it's only 3 days, so it's not enough data to really draw a conclusion, but what looks like a sort of smoothing out or a flattening of the curve, which is kind of what I'm after. So what I gleaned from this was it's not an obvious choice what to run today, and I need to run these three tests again on a larger set of data. So that's what I'm doing today. I'm going to take the data through February 2nd, run these three models, and then I'll be able to run tests across all of February and March and get a much more statistically valid sample or answer of what we should or shouldn't, what I should or shouldn't be doing. Okay, we can talk some more about this on Saturday. Order placed short in the NASDAQ here, 241. That's a breakout signal. And then the ES placed an order short, but it hasn't gotten filled. NASDAQ is live, ES is sim. Yeah, so Daniel, the 6 that you had set for ES, that was because it came from the chart was copied from the NASDAQ. So the NASDAQ being a much, because the amplitude is so much higher on the NASDAQ. Okay, so trailing now in the NASDAQ. And the ES won't get filled here, so that order will cancel as soon as this bar finishes drawing. And the question here is the NASDAQ going to fall apart for us or not? Trailing by 20. Where's the target? Target's down at 95. You're gonna have to clear 6,600 to get that. Good example where if I was, the target there is just set way out at 80 ticks, and I'm just trailing by 20. You would put I would change that target as a human to just in front of 6,600. The result would have been the same, but it's a good example of something that in the future might consider is calculating the targets differently rather than just mechanically like that.